Welcome to today's show. We're talking all today about smart gifting, and I've invited Abigail back from Laurus to talk us through this because it's something that comes up with clients all the time. So welcome back again,
Thank
Abby.
you. Thanks for having me back.
The title for today is Tax Efficient Strategies for Your Family's Future. And I think that really is sort of, clients are pulled in two directions. They want to know that their retirement is on track, and then ideally they want some excess money that they can gift to children.
True.
And then I think we feel at the moment that the government is after our money when it comes to inheritance tax. I had a look. So in 2020, the government took 5.2 billion in inheritance taxes.
Wow.
2024, that's jumped to 7 billion. So what can we do to gift to our families without having to mess things up from an inheritance tax point of view?
I would say number one tip is the earlier you start, the better. There are some exemptions that you can apply when you're doing lifetime gifting. I can touch on a couple of those, but really it's something, there's no quick fix, unfortunately, for inheritance tax planning. It's something that's done well if it's done over a prolonged period of time.
You've got to be quite brave to gift your money early, don't you?
You do. And I think actually coming back to that as well, which obviously Lisa, you would be able to talk on more, but the first and foremost, is making sure that financially you're going to be comfortable for your remaining lifetime. You don't know what's around the corner in terms of care home fees, things like that. So it's worth obviously meeting with a financial advisor, getting a cash flow, modelling that out, because then as part of that exercise, you'll be able to see whether you have capacity for gifting. Because first and foremost, look after yourself and enjoy it, spend the money as well. So do that. And then if you have capacity for gifting, start thinking about the vehicles that you can use and how to gift to your family. So a couple of lifetime exemptions there are. So the annual exemption, it's been frozen for however many years. So
well, for all the time I've been an advisor, which is nearly 20 years, that 3,000
Is it still 3,000?
was always that number. At least I don't have to learn new stuff.
Exactly. So as you'll well know, the first £3,000 per tax year, there's no what we call 7-year rule for that. It falls outside of your estate immediately, so there's no inheritance tax implications. And if you haven't gifted it from the previous tax year, you can go back one tax year as well. So first and foremost, even if you're just using your annual exemption every year, that's still £3,000 you're getting out of your estate.
And if you're a couple, then that's 6 going back once. You can get 12,000 out.
Exactly. And then there's other ones which are even more laughable, I suppose. The small gifts exemption. So currently £250 to an unlimited number of people. A lot of people will use those for Christmas gifts or birthday gifts, but just be aware, if you go 1 penny over the £250, you lose the exemption in its entirety on that gift. So,
and what if I give £250 for birthday? I'm not this generous, but if I did £250 for birthday and £250 for Christmas?
If it's to the same individual, you can't use the small gifts.
So I need to do 125.
Yes, exactly. Yeah, so split that. And again, that's another example of why it's so good to start early, because you slowly chip away at the taxable side of your estate by using these exemptions.
And I think the other rule, so everyone knows, well, not everyone, but it's commonly known that if you're going to gift, you need to live 7 years, otherwise it falls into your estate. But a lot of people don't know about gifting out of disposable income.
Yeah, so an increasingly popular exemption that people are using, so known as the normal expenditure out of income exception, and it's for those that have surplus income. So if you, on a tax year, look at all your income minus your expenditure, if you do have surplus there, you can gift it away. There's no maximum on how much you can gift, but it has to be regular. So you have to form a pattern, but that could be weekly, monthly, or it could be annually. So you could wait to the end of the tax year, see how much you've got, then gift it. And it just can't deplete your own standard of living as well. But yes, because it's got no upper limit, it's a really good one for people that have surplus income.
And I should say that we made together a free downloadable pack, the Legacy Pack, where you can track these things, can't you?
We did, yes. So it's really, really important to document all your gifting, because when you pass away, it's going to be your executors, the people nominated under your will, who will be declaring these gifts to HMRC. So having really clear records is really helpful, and you can do it in the Legacy Pack that we've put together. Even for that normal expenditure expenditure out of income, if you can show intention that there was a pattern, but you didn't live long enough to show the pattern, HMRC will take that into consideration. Okay. So that's quite helpful.
It can just be, if you don't, for whatever reason, download our pack, but
yes,
it could just be an Excel spreadsheet, I assume, or handwritten. Can it be?
Yeah, it can be anything. Yeah.
What do you want? Date of gift, amount, reason?
Yeah, so really you need the date, the recipient, and the amount, and really where it came from. Because also, remember, a gift isn't just cash. It can be a personal item, it could be a business, it could be a car, it could be a property. So you just want it clearly documented, and then you'll be able to put it into the relevant tax years and then apply the exemptions as well. So yeah, anything in writing is really helpful. There is, for the normal expenditure out of income specifically, some people find it quite helpful to download the inheritance tax form that the executor would be completing, and actually to complete that and leave that with their other important documents, then they've got all the information readily available.
And the people sorting out your estate are going to love you.
They will love you. They will love you. Honestly, it's the executors, they have to be satisfied that they've captured your whole estate when they're declaring it to HMRC. And if there's any element of doubt, they need to pay for an unclaimed asset search, or they'll have to get, and I've seen people do this.
What's an unclaimed asset search?
So an unclaimed asset search is basically a search you can pay for online, and it will contact, I think, about 125, maybe even more institutions to identify any dormant accounts. So yes, I would say do that, and then it will avoid 7 years worth of bank statements with people going, well, your executor's going through it, trying to identify gifts. It's a headache. So like you said, your executors will love that it's all nicely documented, and the legacy pack does encapsulate everything they would need.
And so let's say I gift £100,000 to my grandkids, and I live 3 years.
Yeah.
What happens? What happens to those rules? Because it's not 0 and it's not 40, is it?
First, you want to look at, so it depends on the value of the gift. So in your scenario of 100,000, because you've died within the 7-year period, that sum, minus any exemptions we can apply, like the annual exemption, the value, not the gift itself, the value will come back into your estate for inheritance tax purposes and be re-added into the pot.
So if I've given them something that goes up in value,
then if you've given them something that's gone up in value, the value of the gift is what it's valued at the day of the gift. So if you gifted them something that was 100,000 and then like a piece of land, and then there's development on it and it went up to 3 million, you've gifted it, you've crystallized it at that price.
At 100,000.
At 100,000.
Okay.
There may be a bit of hope value there, but for ease of using figures. So yes, you want to gift things away before there's a significant increase in value, definitely. But if you gift away, which is getting into the minutiae now, but more than the nil rate band allowance, which is currently 325,000, if you gift more than that, the excess over that, you may be able to claim taper relief. So the more years you live into that 7-year period, the less tax you pay overall until it drops off out of your estate after 7 years.
Okay. And if you gifted a joint asset, would then 650 apply?
Yes, correct. Yeah, exactly.
As a parent, there's different rules, aren't there? So if I was a parent and I gifted money to my kids, can you explain why that's a bit different?
So in your lifetime, you mean?
Yeah.
So if they are still minors, there is an exemption, the maintenance exemption. So you can make gifts to your children for their maintenance while they are, definitely whilst they're a minor. And I think until they're out of full-time education as well, that exemption applies.
Okay.
But on death, you also get the additional allowance, which is the residence nil rate band allowance, which if you satisfy certain criteria, effectively giving a property to your children, you get up to an extra £175,000 worth of the estate going to them at 0% tax.
Amazing.
So you just want to make sure that your will's prepared to take account of that allowance.
And the world of trusts.
Yes.
Are they only for the super rich with their super yachts?
I mean, I wish I had a super yacht, but no, they're not. I mean, don't get me wrong, wealthy people do use trusts as part of their estate planning to mitigate inheritance tax and to provide for future generations. But there's a whole host of other reasons why you may use a trust. It could be to protect someone that's vulnerable. So if there's someone that you want to benefit that has additional physical or mental needs that you need to cater for, or if someone has addiction struggles, a trust is the perfect vehicle by where you can provide for them, but it's in a structure that you can appoint people that you trust, known as trustees, to kind of manage that trust on their behalf. People use trust to safeguard assets, so to keep it out of the matrimonial pot if they're going through a divorce, or outside of a bankruptcy petition if they were going bankrupt. And also I think we're seeing it a lot more now that, different family structures, there's so many different family structures, blended families are really common, second marriages are really common. So people use trust to kind of provide for lots of different family members, perhaps providing an income to the spouse, but protecting and preserving capital for their children. So I see trust used more and more frequently.
And let's say, fast forward, I'm now 90 and I don't think I'm going to live 7 years.
Yeah.
Are there any quick fix things I can do?
So the 7-year rule is the most common one, but you could, as well as using those exemptions that we mentioned earlier, you would have to speak to a financial advisor on this, but there are certain investments, for example, which would qualify for business property relief, and the survivorship period for that is 2 years instead of 7 years. So you could look at maybe investing in an investment that would qualify for that. And the good thing about that is you can continue receiving the dividends from that investment. So one of the most common faux pas I see in gifting is people giving an asset away but retaining a benefit, and people have to be aware that HMRC will see through that gift. It's called a gift with a reservation, and that 7-year clock that we've referenced will not start ticking until they no longer have a benefit.
I think people often think, I'll just put my house in my kid's name.
Yes.
And that doesn't work, does it?
It doesn't work. It doesn't work. So again, that's a perfect example of a gift with a reservation. So if you are looking to estate plan with the family home, you must get specialist advice on that, because actually if you put the children's name on the title and they no longer reside there, you could actually put your family in a worse tax position, not just for inheritance tax, but also for capital gains tax as well.
That's a good point.
So, because it won't be their principal main residence that they're then selling. So you have to be really, really, really careful. There are things you can do. So, for example, the person that's gifted away the property could pay a market rent to continue residing there, so they're not retaining a benefit. But then their children will have to pay income tax on that because it's rental income. So there's always little things that you just have to be really conscious of, and looking at tax in the round. Something that's great for inheritance tax may inadvertently trigger a capital gains tax bill. So careful planning is paramount, and speaking to professionals such as financial advisors, solicitors and accountants as well. So
if we were to summarise it, steady Eddie, start early, only gift what you know you can afford to gift away. Think of yourself first.
Absolutely.
Really.
Enjoy the money.
Yes, spend it. The amount of times I have that conversation with clients, I think I think they think I get a split personality, because while they're accumulating, I'm quite strict, and then when they retire,
saying enjoy,
go
get the
strict
super yacht.
Instructions to spend. Okay.
Yes, absolutely. So, and all the estate planning best starts with a well prepared will, and lasting powers of attorney as well. And then you can kind of identify from going through that exercise what your inheritance tax liability is, and then you can work back and see, together with a financial advisor, a solicitor and an accountant, kind of the triangle, what you can do to mitigate inheritance tax and provide for your family.
Amazing. Well, thank you for your time, and I hope everyone finds that really useful.